Preparing to live stream. We are live, I believe so, on the old YouTube channel here. This is the CCM Investing Power Hour. This is the show where Ryan and I just go through anything on our minds, and the only rule is that there is no preparation. So we'll hopefully get into some good discussion. I'm sure there'll be plenty to talk about today. But yeah, no rules. And all we have here is just two guys talking. Hopefully people will join. Sometimes people join and ask questions. If you're listening on the podcast, you can join us at 3 p.m. Eastern time, 12 p.m. Pacific time every Thursday on the Chit Chat Money YouTube channel. All right,
Yeah,
Ryan.
these episodes get a strange amount of listens. I would not have expected people like to hear us riff so much, but since the listeners enjoy it, we'll keep doing it for the time being.
Yep. All right. And what is on your mind this week? Anything exciting besides the market turmoil? Of course, we're officially in a bear market. Not down 19%. We're down 21% now.
I was actually reading Saudi America this morning, which was kind of interesting. And that's that new Bethany, not new. It's a Bethany McLean book on basically the oil industry and how sort of the origins, I guess, of fracking and how America kind of became. I mean, I'm not finished with it, so I don't know exactly how it finishes, but how America became sort of an energy powerhouse. And I found it funny that Chesapeake Energy, which is like that stock that everyone gets on Robinhood for free when you sign up, like they had a crazy origin story that I had no idea about.
Yeah, and then their CEO. Well, I don't want to spoil it for you, but you can research what happened to their CEO. I believe that's the one where they had that crazy accident.
Yeah, it's like no one knows whether or not it was like a suicide or something, but it was
Mhm.
yeah, it was like the day after he got some sentence or some ruling against him. Just a crazy story, and I had no idea. I thought it was just some obscure energy company, but they were like a powerhouse there for a little bit, or they were at least much larger than they are today. So kind of, I don't know, kind of a fascinating story.
Yeah,
But that's been my morning so far. Have you been reading
mm,
anything? That's
uh, not lately. Not really anything interesting investing related. Um, yeah, I guess I picked up a book that it was like one of Bill Gates's recommendations. Lawrence Hampton on Twitter, who's always putting out some nice book recommendations. This guy named Vaclav Smil, who is like a really big scientist into energy and stuff like that. So I think it's a similar sort of topic, but not as specific as kind of Saudi America. Kind of interesting on where sort of energy goes and how there's a lot of stuff that, not a lot of stuff, a lot of energy that goes into products. What are the big four that he lays out? Cement, plastics, ammonia, which is fertilizer for crops, for agriculture, and oh gosh, I'm forgetting the fourth. But either way, the globalization around that and the complications are kind of interesting. It's a bit of a dense read, but I thought it was fascinating. And he's a bit snarky, which is kind of fun, but also I would like maybe half of that much because he is mean to a lot of economists and stuff like that. He's got a bit of Munger vibes, which it is good sometimes, but I don't think you can have Munger
yeah,
all day every
it's
day.
entertaining for sure.
Yeah, that is for sure. What do you think of the MLS deal on Apple
I like
TV?
it. I like it as a consumer. Um, I worry that, well, my first thought would be like they might be alienating the 50% of America who doesn't have Apple TV or doesn't have a smart TV, but they're keeping their deals with ESPN and I think Telemundo or Univision. So they should still get at least some of the games, but I think it's a smart move by Apple TV. I've been waiting for um, a streaming service to just gobble up the like a league's rights, and the MLS, some people I mean, a lot of people aren't that into soccer, but it's a growing sport. I think the median salary in the MLS has compounded at a double-digit rate over the last decade. So the money that's being poured into the sport and the viewership is growing. And so I think Apple TV got like a good, I think it was the right move for them. I think it captures a lot of viewers that now have to sign up and have a reason to constantly subscribe.
Yeah, I think it's pretty smart as well. The sports rights are really complicated for these TV streamers and linear as well. And it's hard to kind of gauge what value you're getting or the return on spending. Say, well, MLS is probably a lot less. Do you know the number on the deal?
2.5 billion over 10 years. I remember them saying that, but they get all the matches. Um, I it's not like a crazy number. I think ESPN and either Univision and Telemundo and Fox were all paying like, I think it was like 60 million, 70 million a piece a year. These are all ballpark numbers, so I might be wrong on them. So if you balance it out to 250 million a year, the rights aren't exclusive, but they get all the games. That seems like a semi fair price to pay for a league that's growing. My concern as a viewer was it's only going to be the Apple TV commentators for all the games.
Right.
Which, if they're like a total flop, like if they just absolutely suck, that ruins all the games. And I don't know, that could potentially be concerning. Gonna have to watch the games on mute, but I think it's the right strat. I want to tie this back to investing, not my soccer fanship, but I think that is the right strategy to keep customers subscribing.
Mm-hmm.
Because for the entire MLS season, I'll have that subscription, which lasts a long time. And if you can have like 2 leagues that span the whole year, like where their seasons span the whole year, you've got constant. You're minimizing churn. I know those rights are probably more expensive than some TV shows, but it gets rid of. My big concern was that all these streaming options are so disposable after you watch something that you like. Like if you don't have something, you can always unsubscribe, then resubscribe. Apple, like having streaming rights to a league that goes whatever 6 months, eliminates that for me.
Yeah, I think I agree totally. That combination of nice quality TV content, which Apple has, they're serving kind of their own niche. They're not going for like reality TV stuff or anything like that. But the combination of that plus sports seems like a way better product offering just to keep people from churning. And I know everyone but Netflix had churn problems, and now Netflix is kind of getting back to where everyone else with decent churn problems, although I believe they still have the lowest churn. It seems like Amazon's strategy with Thursday night football falls into that same regard, probably a bit expensive, but during football season, it's in like if you're a Prime member in the United States, you're not, and a football fan, you're not going to unsubscribe. And that's just really, really durable. And it probably leads to pricing power in the future. I mean, if they had the full, I guess no streaming service probably will get the full NFL slate. But if they got some of the Sunday NFL games or a Monday night on Amazon Prime, that could be big as well.
Difference to me is that Prime Video doesn't need a lot of that stuff for Amazon Prime to be worth it.
Yeah, but it still makes it that much.
I mean, it maybe
better.
Increases the pricing power, but like Apple TV, I would not subscribe. I'm not a subscriber to Apple TV, but now I will be for the next 10 years, at least during the MLS season. They kind of needed this, I think. Like they need these type of deals because you don't get the 1-day shipping with Prime or whatever.
Yeah,
they don't have that going for them as well.
yeah,
I guess
Amazon's,
they compare it with like their iPhones or something, like new
Mhm.
iPhone sale, Apple TV as well or something like that.
Yeah, Amazon's coming from a way higher position of strength. And then I think the only last thing I want to ask on this part or this one is, do you think Netflix needs to try to go? I know they only want global stuff, to try to go for a global sports rights like F1, tennis, golf. What are some other ones? I think that would be Olympics is unique, but maybe one of those three or all three of those could really help them reduce churn because I'm getting into F1 and that season's almost year round. I think it's about 3 months of an off season. So 9 months out of the year, they have a week race every other week. Basically, they have 23 in the season. I'm not going to be churning off if I can watch on Netflix. And it's such an easier way for me to watch than through the old janky, whatever ways you can watch nowadays.
We've got a question from Connor Shilu.
You don't want to. You don't want to wait. You don't want to answer what I just my thoughts there, or
I want to answer the question so in case so it encourages people to stay on.
okay.
Keep hold that thought though. It just says he says thoughts on current hypergrowth SaaS valuations. I think there's a chance that a lot of them aren't hypergrowth into the future. So that kind of I don't know. I mean, it's sort of a
Well, it's a broad question. I think there's a spectrum of them. You got to treat it at the individual company level. Obviously, the valuations have come down, but you don't want to anchor. I know there's a lot of charts that go around the last 5 years, price to sales multiples or EV to sales or whatever, any sort of broad-based multiple of it's a like, oh, all-time low since 2017 or something like this for these software companies. But you have to ask yourself, like, does that mean they're cheap? It just because you're anchoring to a time period when the multiple is higher doesn't mean the stock's a good buy now. I think you got to look at it at an individual level.
And that sales multiple, let's say it was higher 5 years ago, the forward sales growth was probably faster over the last 5 years than it maybe will be over the next 5. So it's not, I mean,
and you can say that for almost for certainty with enterprise SaaS because the last decade was just a huge tailwind of adoption as cloud totally boomed.
Yeah, I'd say if you took the category as a whole, I imagine even though I think that enterprise SaaS will grow, I don't think growth will be what it was. The other thing I'll add is I think a lot of people, myself included, did not recognize how much of the excess COVID demand or the quick acceleration because of COVID was actually just temporary. One company that I'm seeing it with right now is DocuSign, where their sales staff is quitting. A lot of their sales staff are quitting because there isn't the low-hanging fruit. A lot of they talked about this, like they were almost like customer support. The sales staff was almost just customer support because they were getting so many inbounds during COVID, where it's like they need whatever this many digital signatures to be allowed, this many seats that the companies do because they have to transition quickly. Now the sales staff is going out there like, can we upsell you? Can we cross sell you to e-notary or whatever? And they're like, we don't really need that anymore. Like we could do this in person if it comes down to it. So it's like some of the companies I do think saw temporary accelerations and may even see declining revenue over the coming year, which is so hard to going from 40 or 50% revenue growth to negative, like declining revenue is so hard to imagine, but it's happening for a lot of the companies, which is pretty crazy.
Yeah, I got to be honest. I have not looked at SaaS recently, really at all, which I guess is maybe helping me not avoid some pain. But looking at it more generally, like I think I saw some charts that the average sales multiple is down to 8 on a trailing basis. Could have been forward, not really sure. That seems reasonable for something that can generate like 20% plus earnings or profit margins. That has a path to grow. But when you have the uncertainty of future growth, which the market usually, a lot of investors get nervous if there's a few bad quarters. And you wouldn't really be surprised if a stock totally drops then. Like really, like if something goes from, like Ryan mentioned, 40% revenue growth totally down to negative. I mean, that can totally throw investors for a loop. But you have to, the difference between that and say a company that has a huge sales staff, maybe lower gross margins, and can only get 10 to 15% profit margins. I mean, an 8 times sales multiple feels very, very, very expensive unless you're growing extremely quickly. Something that comes to mind in that regard that we talked about a lot, I know everyone talks about this one, is Shopify. They had a high sales multiple. It's come down to probably, well, I guess I haven't looked at it recently, probably around 8, right? Sales multiple. That,
yeah, I haven't. I'll look at it right now.
okay. There's a difference between that and then Adobe, who has 40% profit margins, and then Shopify, which has like 45 to 50% gross margins, I believe, ballpark, where their operating margins might be closer to 15%, or free cash flow margins might be closer to 15%. I mean, it's just a huge difference. But either way, the opportunity set, I think in general, has to be better, or else the entire sector was just a bubble. And I don't really believe that.
There was something that was Shopify, just for context, has an enterprise value of 32 billion, according to Coinbase,
That's
and
low.
a 5 billion in revenue. Let me make sure that's right. Yeah, 5 billion, 4.8. So what, just over 6 times revenue.
Okay. Wow, that got cheap fast. Wow.
Yeah, it's at $300. It was at what, 1,700 last year?
Yeah, I think pushing 2,000 actually. Yeah.
There was like this tweet that I saw that I'm gonna get it wrong, but it was basically like, maybe paying developers $400,000 a year isn't a sustainable business model. So like
plus stock.
So yeah, I mean, some of these companies might have 92% gross margin, or 90% plus, 80% plus. And it's so easy to say like, oh, well, they could probably get to 20 or 30% cash flow margins, but they are competing so much for developer talent and paying so much. Like, that's where their costs are, not in the cost of goods sold. Their costs are in the operating expenses. That's almost, for SaaS companies, development talent almost is a cost of revenue.
Yeah, kinda.
It isn't, but like, you have to have it unless you have a business, unless you have a platform that's so sticky that customers will never leave, like an Adobe, like maybe an Autodesk, or I think you could make the case for maybe CRM, or probably Office 365.
Yeah, but they still need, it's the efficiency that the quality companies have. Okay, here's an example. And this is an industry we don't really focus on, but I thought it was really stark. There was the announcement of the Coinbase layoffs, which that company seems to, I think they just got to stop tweeting, because it just creates a whole flurry of controversy. But they laid off, I think, 20% of their staff, and they had somewhere around like 9,000 employees. And then the other exchange, FTX, the founder there was like, we have just way, way less employees. And he was saying something about how most startups or early stage software companies have like 10 times as many employees as they necessarily need. And that is something I think in the future, I kind of want to focus on more as finding a potential investment, because the companies like, and I don't like crypto at all, so I wouldn't invest in FTX, but I would be much more inclined to investing in an FTX than a Coinbase, just seeing those employee counts. Because if you're going to pay a developer, say your top developers in between $400,000 a year and $1 million a year in total compensation, you want to be getting a lot of return from that. And it seems like maybe the developer community got a little, lazy is the wrong word, but like overconfident in how valuable they were to a company. If you get what I mean, where you could just be hired, you kind of do average work. It seems like there's a lot of stories like that floating around.
Yeah,
so I think the employee numbers, the total employee numbers, and obviously that's a generalization, but the total employee numbers and the pace of hiring, which you can look at in all the annual reports. They're required to put employee count. That I think that's kind of important for people to track.
Yeah, it's really one of my biggest red flags when I don't like when management brags about how many employees they're hiring. Like, I understand what the indication is, that we've got all this demand and we're able to meet it by adding employees, but I should be able to see the improvement in demand in the financials or the bookings of the backlog instead of like payroll or headcount. We got another comment that basically says Connor
It's Connor's same guy.
He's been listening on Power Hour on Spotify every week. Thank you for your listenership, much appreciated. He was kind of thinking about companies like CrowdStrike, Datadog, and Snowflake. I'll speak on behalf of both Brett and I for this one. I would say those tend to be outside of our circle of competence.
However,
enterprise cybersecurity, or
not
data,
analytics. Some of those are however, I will say Brad Freeman, who joins the show once a month on one of our not so deep dives, he does a lot of good work on CrowdStrike. He's helped me understand that a bit with his free newsletter. So go maybe check that out. And if you're looking on Datadog and Snowflake, there is a great website called Hypergrowth. Starts with 3 H's, so HHH, and then Hypergrowth. So Connor, if you want to check that out, that has some really, really good stuff on Snowflake and Datadog. I think we did a show on Snowflake. If you want to check that one out, give you the basics of the business. I think we understood it pretty good. But if you want to really understand it, I go to Hypergrowth website. All right, do you want to do the other 2 questions, Ryan?
Yeah, one Nick says, stock pitch idea, since you're familiar with SFM, which is Sprouts Farmers Market, what do you think of IMKTA? I believe that's Ingalls Markets. Definitely has a dominant position in a growing market, Western Carolina particularly. I haven't taken a deep look at them. I know they were in Michael Burry's portfolio for a while.
Seems intriguing.
It looks interesting. We don't. I won't talk about Sprouts since that was in the portfolio, but the grocery. I don't love grocery. Like it's a competitive business, but they tend to just end up getting too cheap. Like the market just seems to overlook them constantly, so it ends up being a good place to fish. But like all else equal, it's not the business model that I'm probably looking for. It doesn't have
I wouldn't put it in my top
competitive advantages.
Yeah, I wouldn't put it in my top 10 like business models. And I think in general, the only way we would maybe be interested in a grocery store if it's trading at, and it's hard to put the artificial numbers on there or restrictions, but like at a PE or price to free cash flow below 10 is kind of where we get attracted to it because we know the growth is going to be so low. But what makes it like not in the too hard pile is obviously grocery is pretty easy to understand. But one, the industry is durable. It's one of the most durable industries out there, whether people got to get food at some point. And 2, they do well during an inflationary period. Now, if there's 10% plus inflation for a sustained period of time, I don't think, they're going to get hurt as well. But with moderate inflation, they actually do quite well just because, again, this is something that's a consumer staple and not a consumer discretionary product. So I like that aspect of the business a lot. And I also like the aspect that online sales haven't really taken off. I know Instacart has decent market share. There's decent online sales in Walmart, but it's still a tiny part of the business. It's around 10%, I think, for a lot of these places for grocery. And there's a real estate advantage as well. So those 3 combinations kind of make it attractive. But it's not some super high quality business model at all.
Yeah, I'd agree. But I don't know. Just on a quick look at Ingalls Markets, I might take a deeper look, but I can't really. Sorry, Nick, can't provide any crazy value to that question right now. Jonas Anderson asks thoughts on Meta, otherwise known as Facebook, in a past life. Thoughts on their stock, price to earnings at 10, low teens growth, cheap or reasonable. Greetings from Denmark. Ooh,
there we go. First, I think that's our first international watcher, although on the podcast, I know a lot of listeners are from Europe, the Nordics, huge investing community out there.
Yeah, as for Meta, it's to me it's like just a total conundrum, and it's something that I've looked at on several occasions. Our friend of the show, Matt Cochran, has, I believe, pitched them before on the show, or
Yeah,
we've
he
talked about
puts
them.
he does some great analysis on them over at Seven Investing.
Um, I love the core business. Obviously, one of the best business models because of the network effect, but I I don't I don't love this whole VR metaverse thing. I just really don't, and I don't like. I'm just not a fan of the capital allocation. It's. I mean, I do think they will generate probably stable, if not growing, cash flows from their core family of apps: WhatsApp, Instagram, Facebook. Am I missing any there?
Messenger, but that's kind of a part of Facebook.
Yeah, but if the bulk of that cash is going to is essentially being incinerated.
Yeah, it's not.
Let's say it's not being incinerated, but let's say that Meta, Oculus, it was a flop. Let's say they pour $50 billion over the next 5 years into this initiative, and it generates $0 in cash and probably negative cash and $10 billion in revenue. I'm going to call that incinerated, and that is, I mean, that's detrimental to your returns because that is your, on a trailing basis, it looks cheap, but you're getting, as a shareholder now, you are getting the future cash flows of the business, which that cash isn't going anywhere other than to the developers of this Oculus that potentially doesn't become anything.
Yeah, and it's
It's
not
a
just
huge risk.
Oculus. Yeah,
Yeah,
but yeah,
there's a lot of different elements to their all their VR stuff, but it just seems like a giant risk that I wouldn't be comfortable with as a shareholder, and I'm just not a huge believer in it. So I guess those are my two gripes. Irish-born investor friend on Twitter says I'm finally here, so we got him on in the chat as well. Hello.
the big European audience say, yeah. I mean, with Meta, it's so interesting because I do think there is a world where what from today's prices to say 2030. If they buy back stock at an attractive rate, if they don't just hemorrhage money in these new VR investments, you could have 15% compounded returns through 2030. If they buy back enough stock at these levels, I mean, they can do a lot. They got a conservative balance sheet. Instagram seems to be executing really well to counter position against TikTok, and that's great. WhatsApp still has a ton of potential. I love what they're doing with payments in international markets, although it's not going to be that meaningful. I don't know why I'm still out.
You were in Mexico, and you said WhatsApp was like a way bigger business than you thought, right?
Yes, it is. Not necessarily business, but just usage. It is the combination of messaging. So anyone that would be using iMessage in the United States, all that stuff's on WhatsApp. They also have some status stuff, like it's a little bit Snapchat-like for a lot of people. People posting statuses, kind of like, you know what I mean? Sorry, not statuses, stories. They call it status. And then it also replaces email communication for a lot of businesses, for WhatsApp Business. So it's pretty sticky with a lot of these customers. So like any sort of company I was communicating with or any sort of individual I was communicating with, it was all on WhatsApp. And that's probably undervalued, but the business is so large and WhatsApp generates so little revenue right now that I have trouble seeing how valuable that could be, although it is a bit of a call option over the next decade. I think it just comes down to growth of Instagram. Facebook doesn't fall off a cliff. And then how much money they're burning in their buybacks. It seems like there could be a path forward here, but I don't know.
Yeah, the cynic in me just says like cut the metaverse spend, start buying back stock, but would
They can do both.
could they ever be obsolete if they don't keep investing?
Yeah.
That's probably the big concern for
I think
management.
the holdup for me is I don't like social in general. I don't know. It's so hard to predict, and you constantly see new competitors come into play. What's that new one that was up on the charts? Be Real. I
Yeah,
don't know
that's
anything.
not gonna
I don't
be.
do these. I don't know the social platforms at all.
That
I'm like a
one's.
grandpa.
I think that one's gimmicky. That one's like I know how it works. It sends you a ping once a day at a random time, and you just have you have 20 minutes or whatever to take a picture of what you're doing. And so it's meant to be like that's the authentic you. It's like real social media. But something tells me that's not gonna be like that. Something tells me that's a product, not a company. And TikTok though seems to have eaten everyone's lunch, and you're just competing on time spent,
Yeah,
which is like the most competitive place in the world. That
but it's
part
still
does kind of
but
concern me about social, but
the stock's still cheap though. The stock's still cheap. It's not as egregious as the people talking about Coinbase at 3 times trailing PE, but I do like.
can we talk about that? Did you see this
Uh,
petition to have the executives removed from employees?
at Coinbase, no, explain.
All right.
Hold up.
I want to make sure I get it right. The uh basically a bunch of employees banded together and said we need to remove the executives. And Brian Armstrong posted it on Twitter and said, "This is so dumb." And I'm like,
Dude,
dude,
that's not
why
the
would you do that? And then they fired 15% of their workforce or something like that, 2 weeks
Whoa.
later.
That was okay. I thought that was more like after the firings.
Well, I think it was not related, but this guy's just lost the ball. Brian Armstrong. I couldn't think of a more poorly managed business right now. Let me pull it up. Plus, I think their demand is just evaporating, and there's all these platforms just losing or just locking up accounts. Are you serious?
Yeah, well, yeah, we don't want to do any Schadenfreude because we have been crypto haters. Part of me smiles when all this stuff goes down, but it does really suck that these companies treat people so badly. Yeah. No words from Ryan.
I was on mute. I'm looking for this this hilarious tweet. The gosh, I can't find it now, but he honestly might have taken it down.
Most
No,
likely.
no,
Most
yeah,
likely.
no, he did not take it down.
Okay.
Okay, I'm pulling it up. According to so it was a post on Why Hacker News. It says Coinbase employees petition to remove execs. Brian Armstrong posted it and tweeted, "This is really dumb on multiple levels." Well, of course, it's dumb from your view. And then he goes on in this giant thread to say, I want to make sure I get it right. Basically, it's praise in public, criticize in private. That's our culture. But he starts the thread with, "This is really dumb on multiple levels."
So he is hypocritical on that.
And then, all right,
yeah.
so that was June 10th. June 14th, another one of these threads, which I always laugh whenever I see him starting a thread. "Today, I shared that I've made the difficult decision to reduce the size of our team at Coinbase by about 18%. Come on.
Yeah, it just doesn't look great. It doesn't look great. And the fact that they cashed out on that direct listing. Yeah, I don't know. All right. Let me scroll through the.
All right, you were talking about the Formula One rights, and I cut you off. So.
And international sports rights for specifically for improving Netflix's churn. Do you think here's maybe a better question there? So they said they're going to invest a lot of money into mobile games. Do you think it would be better spent to get some sports rights, either Formula One, maybe a tennis, golf? Those are the 3 I was thinking of for international rights that are popular.
No.
You don't. What? No to what?
I mean, obviously the Formula One stuff was a huge success, but and if they were going to go the sports route, I think international is probably the way to go because they already have such sort of a stranglehold on the like America, like
Well,
the
they said
American consumer.
they said that they would only do international. That's why I mentioned that.
But
And international, I mean global, like it's including the US.
yeah, but it's not solely the US.
Yeah.
The I would not like them to replace their gaming spend though. Unlike most people, I actually think the gaming strategy is a good idea, especially if they go with some sort of like a lower price tier, because the mobile games are pretty unique. They just announced that they're coming out with like a Queen's Gambit based video game that's like chess tutorials and then you can play against other people. Like I could
It's
see that.
chess. It's chess.
Yeah, but mobile chess, like I mean, think about how popular chess was after the Queen's Gambit. You know, I don't know if you
Yeah.
remember that. Like keyword
Mhm.
searches for chess were way up on Google. The I could see that being a huge success, and they're also like it's just a way to get more people. I mean, right now you have to be a member to play these games. You have to be a subscriber, but if you can be a lower price subscriber, let's say $2 to $3 a month, it's essentially the Apple Arcade business. And like I could see that actually working out. I think a lot of these mobile games certainly have a niche that they can target and have success with. And it introduces a lot of people to Netflix to potentially become
I
a
thought are
higher price
they
subscriber.
are they available outside the Netflix subscription? I thought they were only within the Netflix subscription.
They are, but I'm saying if you end up doing, they're talking about this lighter tier, ad supported.
Mm, gotcha.
That seems like something that could work to me.
Yeah. It kind
I
of
think
comes
you have
back.
to do it. I think you have to have for the games component to be a big success. I think you have to have some sort of an ad supported tier, or else you're already getting subscribers that are just playing on their phones. It doesn't seem like a huge value add to me.
Yeah, that's I don't know. I have no good opinion on the gaming one. So I don't think it's a good idea, but I'm open to being wrong.
Two more. Okay, wait. Last thing I'll say. There's two more questions in the chat that I want to answer, but the last thing I'll say on Netflix: are you signing up for the real life Squid Games?
No, but that's a good idea from them. They
That's brilliant, isn't it? I
Yeah, it's a
like
good
that.
idea. Yeah, making that reality show. I do think they can be more successful if they focus on their tent. What do they call those things? Tentpole. The successful shows like uh Squid Games, Squid Game, Stranger Things. The Witcher's a little different because it was already a video game. And like Bridgerton, and kind of trying to make more stuff off of those brands instead of just plowing, just constantly having these new stuff. Stranger Things game, I think they should probably invest a ton into that. Kids would love that.
They're doing right now. They're doing three. I think it's three games are going to be coming out in 2022 that are based off Netflix shows. Queen's Gambit game. One's like La Casa de Papel. I've never watched that, and then there's a third one that I don't know, but those are all popular. So I think they're kind of taking that approach that you're talking
I would
about.
hope. Yeah, I read something that they were doing that, but who knows? They changed their strategy a lot. So
Two questions. One from Jonas Anderson. He says, "Do you believe FANG stocks will outperform the market over the next 10 years?" Thanks for the answer, guys. I'll let you go first.
okay, preface this with there's a lot of uncertainty. And what's FANG here? So FANG is, let me just kind of think of them in my head.
Let's
Facebook,
call it
Alphabet.
FANMAG. Let's call it FANMAG.
No, well, he says FANG. Okay.
I
Are we
feel like
including?
people have to include Microsoft now.
Okay, you include Microsoft. Netflix is in there. I will
Or Nvidia.
go. No, I think it's always Netflix, even though Nvidia is much larger. They always is that no one really considers Nvidia.
The N is interchangeable.
I would go with yes, but as you can tell by the tone of my voice, not a strong answer. I think they trade very reasonably.
Well, the difficulty here is that FANMAG will drive market returns over the next 10 years, I imagine. So the majority of them.
You're discounting the old Tesla there. Come on.
This is only what, 2%?
Yeah.
Less?
Probably less now, but
yeah, I think FANMAG will do really well.
Especially because energy is still so, doing so well right now. If you kind of get what I mean there.
Not quite. Keep going.
Like, since energy has had a huge resurgence, the starting point of kind of competitive returns within the S&P 500 it's better positioned for FANMAG right now.
Yeah, that's probably accurate. Facebook, we kind of just talked about it. It's a bit of an anomaly, but Apple, Amazon, Microsoft, Google, can we call those maybe four of the best businesses ever?
Yeah. Well, I don't know about Amazon retail to TBD, but yes,
I think they'll figure it out. Those are, let's call them four of the best businesses ever trading at, Google and Microsoft, I believe, are trading at fairly reasonable multiples now. Amazon is as well, assuming they can get back to cash flow positive or at least break even on their retail business, or at least stop hemorrhaging money. I'll take that over the market for the next 10 years, definitely.
Yeah.
Mine's a little more confident than yours. All right, next question. This one's a little more fun. We do own Wix, so try not to pump it too much. It says Wix trading at a Shopify multiple or Shopify trading at a Wix multiple. Which happens first? It's a good question.
Wow. You better, for Shopify shareholders, I hope that doesn't trade at a Wix multiple, because that would be a lot of downside from here.
Okay, all right, let me rephrase the question then. Let's assume they're at the same multiple. Which do you take?
Oof, that's a good question.
Right now, I think Wix's EV to sales is probably, just like off the top of my head, in between 1.5 and 2 times. I think Shopify's at 6 times. Let's say they meet in the middle, 3.5 times.
Yeah, but that's not this question. That's not this question. I think Wix going to 6 is more likely, because Shopify going down to 1.5 is very unlikely to me.
Yeah, that doesn't seem reasonable.
Never say never.
But going from 50 times to 6 times seemed fairly unreasonable to me as well.
That I disagree with that.
Let's say Wix's management has said that they think they can get to 20% free cash flow margins by 2025, I think was the number. If the business is generating 20 cents on every dollar in cash, I don't think it makes sense for them still to be at 1.5 times revenue. So yeah. I would say it's more likely that Wix re-rates up than Shopify re-rating down, if management's right in their projections. Every company looks good if management's projections are correct. But
that's right. Every investor day, if you watch those, the market's going to rip higher.
I'd love to see just an investor day that's like, we're not going to make it. It's an investor day to short a company.
Yeah, we are liquidating. That's the whole investor day.
If you want to use this as a liquidation event, that's that'd be quite the investor day. I do like that question though. That's an interesting one. And you know what? Yeah. People no one would compare those two companies during last year. Like, oh, they're two totally different businesses, and they are still fairly different businesses. But now everyone's making the comparisons because of the valuation re-rating. So it's kind of interesting. We got another question, which is, this has been fun. I like having a active chat. Tyler Hamill, have you guys found a single former SPAC you like? A lot of names to sort through, but a lot of names down more than 90%.
Oh, I got one. Sorry.
Go ahead.
So there's one. Let me read you off this capital structure here. Market cap 191 million. Cash and investments 263 million. Debt 2.6 million. So enterprise value negative 70 million. That is Latch, who kind of they cut a lot of employees. and they're hemorrhaging money right now. So don't trust that EV. But I thought that was interesting. That's the only one that I kind of like their business model. I do think they'll probably end up burning the majority of that cash pile. But if they come out the other side, the stock could be cheap here. It's just really, really uncertain. Like there's, I'm
I feel like you
watching
can say
them.
that for every spec. You can say
No,
that.
this one has great unit economics. Latch, I
Yeah,
think. Latch, I believe, has great
Really?
unit economics.
Could.
No, it does. It does.
How much are they burning right now on every dollar in revenue?
Oh, well, a lot on a cash flow basis, but their software margins are fantastic. It's just
Yeah, but you
whether they
don't
can
get
scale
the
them up.
software margins without the hardware implementation. So the hardware implementation is a part of the unit economics.
Sort of. Not after they get installed at a apartment building, but they have to get enough installed first.
That's yeah. I don't know. It feels like such a tiny chunk of revenue right now.
That's the only one. That's the only spec that I'd follow. Matterport's interesting, but that one is just kind of one of those.
Like I don't understand the competitive landscape kind of for Matterport. Another one that is pretty interesting, but isn't down very much. We had the CFO on a recent episode, Haggerty. It's not sort of like, it's not your typical SPAC. They aren't really, they aren't hemorrhaging money, and they aren't like some newfound idea. They've been around for a long time and just, I think, maybe chose the wrong way to go public.
Well, the State Farm had a SPAC or something, or Markel had a SPAC, and they were already investors, something like that.
Yeah, and State Farm and Markel invested, but it's not, I wouldn't say it's like, you're not dumpster diving like you might be with some of these other companies that are like down 95%. Haggerty, I think, trades at like 10 times book. So
yeah,
it's not cheap.
And yeah,
but it's a good business that grows constantly and has a sort of a State Farm. If to me, if state, so they are the lead insurer, the lead specialty insurer of classic vehicles, or like the enthusiast vehicle market. And so it's kind of like this niche, and State Farm, who's one of the largest national insurers, basically partnered with them, and 9 out of 10 of the largest national insurers have partnered with them. So that's kind of, to me, validation that this is a market that is hard to compete with, and that Haggerty's a little bit difficult to disrupt, maybe a little bit of a moat there.
Yeah. Shouting out our own interview. Listen to him. What was that? A few weeks ago? Something like that. Pretty interesting company. Never heard of it, but seems very attractive.
SoFi.
SoFi's
kind of interesting.
Yeah.
It's fairly interesting. I was looking at it this morning.
Good, solid business for sure.
Yeah, the student loan moratorium has hit them pretty hard because so much of their interest revenue comes from loans held.
So that's a bit of a hang up until this kind of gets solved.
Yeah, and they're investing pretty heavily in their other offerings, which is like, if you're investing heavily and not collecting revenue for a sustained period of time, you're going to be burning cash. So that's a bit of the hang up, but still an interesting model, and they continue to grow members. Plus that Galileo thing, that API business continues to grow. It accounts for like 20% of revenue now. So interesting business.
Like we mentioned earlier, Brad Freeman, he covers that one too. So he has a lot of good write-ups on that. Yeah. All right. Here's something before we end. We have about 9 minutes before Ryan has to hop off. Inflation predictions that are meaningless. All right. Here's what a good macro guy, Colin Roche on Twitter, said. My crystal ball is pretty hazy, but here's how I see this playing out. 1, oil booms into the summer. That's disappointing. 2, commodities crash Q3, Q4. 3, defaults surge by Q4. And 4, debt deflation becomes the dominant risk by Q1 2023. I don't know why he's thinking these things, but he did show a chart.
Go through it one more time.
Okay,
I didn't catch the first part.
1, oil booms into the summer, so continues to boom. 2, commodities crash Q3, Q4, probably because from demand destruction. 3, defaults start surging by Q4. 4, debt deflation becomes dominant risk by Q1 2023. And he is showing a chart, I believe, and I'm not a credit guy. He's showing a chart of the high yield spreads, and they're starting to creep up again. So I think that was kind of his indicator, part of the indicator there, which they typically do during a recession. Either way, that if that happens, inflation would go down. What is your guaranteed to be wrong inflation prediction? Because we just had it come out, last Thursday? Yeah, a week ago.
Well, Colin Roche is definitely smarter than me, so I might just agree with his take. That seems fairly plausible. Something else that kind of sparked for me. So I don't have an inflation take. Like,
no, you have make a predict. You got to make a prediction.
Persists at more than 5% for the next 3 years.
Wow, that's pretty strong. That's above what a lot of you're in the inflation sticky.
10-year, the 10 years at 5% in 2024.
But then you said on the other show, you said it'll abate within the decade, right?
It will abate over 10 years. It will. The deflationary factors, i.e., innovation, which I know that's like the whole ARC thesis. So,
but it's right. I mean,
not some ARC truther, but like obviously that's helped, like, deflation over time.
Shale was innovation.
So I think inflation will be I don't think we'll have nearly as much inflation by the next decade. But that brings something up for me. Remember how everyone was talking about how if you don't have debt, you can't go bankrupt, last year? And that kind of made sense to me at the time. But if you don't have debt now and you don't have cash flow, I think eventually you'll have debt.
Yeah.
Because they're the only ones that'll give you money. That to me seems like it's funny how quick you can turn from a no debt company to a debt company.
Yeah, a lever company. Yeah. Interesting.
So you will go bankrupt eventually.
Yeah.
Assuming you take on some debt.
Yeah. It's hard. I think there is always uncertainty if you're not generating steady cash, consistent cash, because we have a few portfolio companies that generate consistent cash and they took advantage of the debt markets and got, say, 20, 30 debt at 3%. And with inflation, that's going to be beautiful to have, especially if they just start buying back stock at cheaper prices. But the only way they are able to take advantage of that is because they're generating cash. So if you're not profitable, it just leads to so much more complications.
All right, we've got 5 minutes left, and we got a great question here because it paints us in a good light. So I'm going to go ahead.
Well, somehow I'm reading it. Partially, maybe.
It kind of paints us in a good light. He says, "Did you guys feel?" And this is Jonas Anderson. Thank you again for the question. Did you guys feel the FOMO, for any of our listeners that don't know what that means, fear of missing out, in 2020 to the 2021 market, which was kind of when everything was booming? You guys remained skeptic over a lot of growth names like C Limited, which went up every day but is down big now. Like, I think we probably did get some FOMO in that it just felt like everyone was posting their holdings and we're up like 100% every year. But I would say remained fairly price disciplined relative to other investors, but relative doesn't really matter. So it's like a lot of the
made
companies,
some mistakes with
we made a lot of mistakes. Yeah. I do think generally we ended up turning over a lot of rocks and ignoring them, even though we liked the businesses. C Limited in particular, it helped that it wasn't domestic because I didn't quite have a good grasp on the business.
Yeah, I definitely had FOMO. I don't know if FOMO is the right word. I had doubts about myself when crypto was rising. Uh, when something like Shopify was at 60 times sales, and I was saying it was ridiculous at 20 times sales. Um,
Yeah, that
like
was
I,
because people kind of hated us for it because we were like critical of. It's like the companies can do no wrong at that point, which that didn't make us popular with a lot of the people, a lot of the shareholders of certain companies. But so that was probably the prevailing feeling as opposed to FOMO, more of like, are we risking relationships or reputations by being too skeptical or cynical? That was probably
yeah,
more of my feeling.
yeah, the yeah, it's interesting. I think if you feel FOMO, you gotta like because people definitely do. People talk about that. That's not really something that is a huge concern for me psychologically. But if you know that you get FOMO, you need to create some artificial barriers or rules based things to keep you from buying a electric vehicle SPAC with no revenue at a $60 billion valuation, something like that. You kind of get, does that make sense? You think, Ryan?
Yeah, I think sometimes, even though I say no hard rules in investing, I think certain hard rules help, like avoid detrimental mistakes. Let's say you had a hard line at nothing over 20 times sales, which most people probably should. The Even though you might miss some, you're probably going to be the better for it.
Net, yeah, net, you'll be better.
Um, and it helps you avoid making the easy mistake of overestimating what a company can grow at, which is so easy to do when times are good. I mean, how many people extrapolated out like 30% revenue growth for a lot of these SaaS enterprise companies for the next decade? It was very easy to do at that time, or even other companies, not just SaaS enterprise, because they had 5 years of that or 5 years of 70 or 80% growth. It's super easy to extrapolate out 30%. Most companies do not achieve that. So, especially when capital isn't quite as cheap as it
Yep.
is today. Last question before we have to go because we got 1 minute left. How do you evaluate names right after a big acquisition and before their first report as a combined business? That's a tough one. Hopefully, they put out a good prospectus that could be helpful. You said Take Two Interactive for an example. Take Two Interactive had I think it was like a 400-page S4 that was really helpful, and they went through like independent projections for each business that I found to be pretty useful.
Yeah. That was
And
only
then
like 2 pages of it. That was probably what you needed to needed to actually read. Most of it's like
yeah,
lawyer stuff, but
yeah, and then management and any commentary on the conference call can also be helpful. Acquisitions are, I would say, maybe a great like an area that I'm not great with. Like I can always envision the synergies, which is probably the bad way to look at most acquisitions.
yeah, I like to look at what they said during their merger presentation, and then a year later or a year and a half later, was it close? And if so, then maybe that we were right about it. But if not, what went wrong? All right, we get it. We get to wrap up.
Yeah, I think that's gonna have to do it.
Okay, well, make sure if you're listening, I know we had a good audience today, but if you're listening on Spotify or Apple or wherever, join us 12 p.m. Pacific, 3 p.m. Eastern, live on YouTube every Thursday, potentially Wednesdays. Sometimes review us on Apple or Spotify. That's the easiest way to do it. Remember, we are not financial advisors. Anything we say on this show is not formal advice or recommendation. We are, however, general partners at Arch Capital. Arch Capital clients may hold securities discussed in this podcast. Thank you all for listening.